Welcome to this issue of Retirement Crusaders. Today, I want to talk a little more about preferred shares and why many financial advisors don't recommend them. They're hush about them. I'll explain why they don't mention them, because they may not be good for the financial professional, but they couldn't be very good for you as the investor. I have many preferred shares that pay fixed dividends of 9% and more. And I'll explain how they work, and then you can decide if it's something that may be appropriate for your own portfolio. So first, let's talk about how these preferred shares come about so you understand the background. Then we'll get into a little more details. So when a company wants to raise money, they have three basic choices. First choice is they can sell stock to the public. Well, they try not to do that because the existing shareholders don't like that. In other words, if a company had 10 shares of stock outstanding and you own one share, you would own 10% of the company. If they then decide to sell another 10 shares to make a total of 20 shares outstanding, and you still own your one share, you now, instead of owning 10%, only own 5% of the company. So as an existing shareholder, you don't want the company to sell any more shares. In fact, you want just the opposite. You want them to do buybacks. And in fact, people often prefer, smart investors are looking for companies that buy back a lot of their stock because that's good for the existing shareholders. So companies don't like to sell new shares to the public. What are their other choices? So we talked about method one. Let's talk about method two. They can sell bonds to the public. So a bond is really taking a loan. So they find investors who want to loan them money, and then they take their $100 million and pay them whatever 6% interest every year for the next 10 years. Well, they don't like to issue debt if they can avoid it. Why? Because when the Wall Street analysts look at a company, one of the things they're always looking at is how much debt does the company have in relation to their earnings, in relation to their equity. And if the debt starts getting too high, that tends to hurt or depress the way analysts look at a company. So companies that don't have much debt, no problem. Issuing debt is great because it gives them leverage. They take in money, they can invest, they pay out interest at 6%, but they can go and invest that money and earn 15%. Perfect. So issuing debt is not bad per se, but companies who have debt levels that are approaching the limits where maybe they're risking a downgrade. Maybe they're risking a change in their rating from what's called investment grade to non-investment grade. So that's why companies might resist issuing debt, because they don't want to hurt their profile in the eyes of Wall Street and the analysts. So there's something in between they can do. Number three, the middle ground, is preferred shares. So on the balance sheet of a company, if they sell bonds, that shows up as debt. When they issue preferred shares, it shows up as equity. So it doesn't hurt the standing or the debt profile of a company because preferred shares are equity and not debt. Okay, so that's one reason a company may prefer to sell preferred shares rather than sell bonds. Preferred shares, however, for you, the investor, have a fixed dividend just like a bond. So the idea is preferred shares kind of are that middle ground. They don't show up as debt on the company's balance sheet, but to you, the investor, they look and feel like a bond. So it's a great middle ground for companies and for many investors, and it can work out well for everybody. So let's take a closer look. How do you judge the safety of a particular preferred share? Well, let me show you. Let me see if I can change screens here. So here's a preferred stock that I own. Now, this is not a recommendation. This is an educational video. I'm showing you this just for education. So here's a company. It's called Chimera Investment Company. It's a mortgage real estate investment trust. They lend money secured by property. That's their business. Now, I could buy their common shares, common stock, just like you'd buy common stock in Microsoft or IBM or, AT&T. I could do that, but the problem with common stock is if we look at the chart here, it can be a little more, the common stock can be a little more volatile than the preferred shares. You'll notice, in fact, let's go over 5 years here. The preferred shares over 5 years, except for, COVID here, you notice they don't change a lot in value. So that's preferred shares are for more conservative investors who are looking for things that are more stable. However, the price of a preferred share will bounce around. What causes it to bounce around? Mostly changes in interest rates, because they behave very much like bonds. If interest rates go up, the preferred share value will tend to go down. If interest rates go down, the preferred share value will tend to go up. However, the beauty of preferred shares to an investor, they don't usually care. Why? Because they own it permanently for the dividend. They buy it for the dividend, not to try and make a profit. So this particular preferred share right now, see, it says dividend rate forward, $2. So this preferred share pays $2 a year for each share. That's a fixed dividend. So at the current price of $21.73, the yield is 9.21%. So how do we know if the dividend on a preferred share is safe? Well, you can look at what kind of cushion there is. Well, let me show you what I look at. If I go to the financial statements, the income statement, and I scroll down here, I see that the net income for this company, I don't know, it bounces around 400 to 500 million in most years. Here was a bad year. Here was a good year. Here was a year when they lost some money. Here's the last 12 months. So they had about $200 million of income, and the preferred dividends they paid were $73 million. So it's about, let's just round off, for every dollar in preferred dividends, their net income is $3. So I feel pretty comfortable with that even if their net income dropped in half, they still have plenty of money to pay my preferred dividend. And that's all I care about. I just want to collect that check for as long as I live. So what if you said to yourself, I don't feel so comfortable with that. I need something that has more safety. Okay, that's why there's different flavors for different folks. That's why Baskin-Robbins has 31 flavors. So let me go to Bank of America here. Back up. Let's go. BAC. Let's look at Bank of America Preferred B. Okay, so here's some shares from Bank of America. And let's look at the same cushion, the same safety issue that I looked at just a minute ago. If I scroll down here to net income, okay, so here's their net income, bounces around 20, I don't know, let's call it 23 million, seems to be an average of the last few years. So, but their preferred dividends are 1.6 billion but they have 25 billion to cover it. So in other words, for each dollar of preferred dividends that Bank of America needs to pay, their net income is 15 times that. They've got a ton of money. Their business could go in half and then in half again, and they'd still have enough money to pay their preferred dividends. So this preferred dividend is super, super safe. That's why if we scroll up and take a closer look, we'll find that that's why the yield on this preferred is 6% instead of 9%. It's super safe, so you're getting a much lower yield on your investment. So each investor gets to decide how much safety you want and what you feel comfortable with. Now, let's talk about why it is financial advisors don't talk about preferred shares very often. Well, those who charge commission, they can't earn very much. If you went to Schwab or Ameritrade or any of these discount brokers and you said, I want to invest $25,000 in preferred shares, the commission might be $10. I mean, just something tiny, I don't know, $20, $10, something like that. If you went to a full service brokerage company, with a financial advisor and they charge you commissions, I don't know what they would charge, maybe 1 or 2% commission. Well, he doesn't really want to sell you that, because then for the next 10 years, while you own those preferred shares, he's going to earn nothing. So he doesn't like things that just sit around forever, like preferred shares and bonds. He wants to sell you common stock, because you buy some common stock today, then it goes up 20% for the year. Then he says, oh, we should take our profit and then we should buy this. So he wants to buy and sell and buy and sell. Well, you don't do that with preferred shares. You buy them and you hold them. So he doesn't like that. Now, what about your financial advisor doesn't charge you commissions? He charges an annual fee, say 1% of your portfolio. Well, that guy also doesn't like preferred shares. Why? Because he doesn't want you one day looking at your statement and saying, I have 1/3 of my portfolio in preferred shares and bonds. They don't change. They stay there all the time. Why am I paying him a 1% fee on that money every year? You see, your fee-based advisor knows that you expect for your 1% that your fee that you're paying, you want to see something happening. You think that, oh, it's better when I see buying and selling, then I'm actually getting something for this fee that I pay him. So he's worried that if he doesn't buy and sell things in your account, you're going to leave, because you're going to say, what am I paying him for? So he doesn't like to put preferred shares and bonds in your account, because they never trade. They just sit there for years and years and years. So that's why financial advisors tend not to mention preferred shares. If they do, they'll talk to you about a preferred share mutual fund. Why? Because they make much more commission from that. They might get 4% when they sell it to you. They may get 1% a year. There's much more fees built into mutual funds than if you buy individual preferred shares, because you don't pay any annual fee when you're sitting there holding your preferred shares. So this is why financial advisors don't talk about these that often. Now, how do you find preferred shares? Well, I use Seeking Alpha. So if I go over here to the search, preferred shares. So if I type that in the search, I'm going to actually click on people, because I want to see people who research preferred shares. Here's a guy who calls his little channel on Seeking Alpha Preferred Stock Trader. So if I click on that, here he's got these articles: Bargain Westco Preferred Stock, Argo Group Preferred Stock. So it looks like he's writing in Two Rhythm Capital Preferred Stocks. So it looks like he's writing an article every, I don't know, once or twice a month on Kemper Baby Bond, which is a preferred stock, EPR Property. So he's doing a review every couple of weeks or month on a different preferred stock. And he's not the only analyst on Seeking Alpha doing this. There's about 3 or 4 of them. So you could just follow these analysts and constantly be reading articles about preferred shares that they've researched and they recommend. So that's an easy place. And I think below in the description, there's a link to Seeking Alpha. I'm not sure if they may have a free trial account right now or not. Full disclosure, they may pay us something. I don't really know. All you can do is click the link and see if they have some kind of deal going, and you can take a look on Seeking Alpha and follow some of the guys who talk about and research preferred shares. A couple other sources that you can find. There's some Preferred Stock Channel. These guys have a lot of good stuff. Let me just copy and paste it here. Preferred Stock Channel. Okay, so they have, let's see, if we go high yield preferreds, high yield monthly preferreds that pay monthly rather than quarterly. Most pay quarterly. Convertible preferred shares, largest discount. So they have a bunch of lists of different types of preferred stocks. So there's a ton of information on the Preferred Stock Channel. Here's some educational articles. So this is a really great place to go look and research preferred stocks. One more site I'll mention, Quantum Online. This is really good for details. And let me show you what I mean. So let's say you were looking at a particular preferred share. You read some article about Bank of America preferred B shares. And you wanted to find out, well, exactly what are the call dates and is it cumulative? You wanted to know some details. Well, over here in the quick search, I type in the symbol for Bank of America. I click search. Well, here's the details on Bank of America, but I'm not interested in their common stock, which is right here. I'm interested, see this link, find all related securities for Bank of America. I'm going to click here. And then all of their different preferred shares show up on a list. I'm interested in researching this one, so I click on the link. Now I can read this description, and it tells me exactly, it's non-cumulative. It tells me when the call dates are, the coupon, it tells me all the little details that I want to know. So, so this is a great site for really detailed research. If you have a question, you know, some detail that you want to know, Quantum Online is really, really good for that kind of stuff. So now you know a little bit about preferred shares. You know why your financial advisor doesn't mention them to you. These are really great for retirement consistent income. Hopefully this has been some value to you. I'll be talking about some other preferred shares. I'll get into detail on some individual issues in future videos. Hope to see you then. See you next time on Retirement Crusaders.